Okay, all in, Farid, to you.
All right, thanks, Caroline. Good evening, everyone. My name is Farid Rizwan, and I am the Vice President of CFA Society Malaysia. So welcome. I would like to bid everyone a huge grand welcome to our first flagship event of the year. CFA Society Malaysia presents Navigating 2022 Market Outlook Forum. And with us today, we will have a lot of things to talk about. But before we get into that, let's get the housekeeping rules sort of out of the way first and foremost. So before this, let's really just talk a little bit about how the session is going to go. So the session is about an hour and 30 minutes, including the Q&A session. And it will start off with about 5 to 10 minute presentation by our panels, followed by a Q&A after that. And then we will also like to ask everyone to keep their mic on mute as to not disrupt the flow of the event. And of course, finally, if you want kind of miss out on anything, no worries. We will upload this session onto our social media channels, our YouTube, as well as on the ARX platform. So with that out of the way, I would just like to also welcome everyone to our session for today. And let us just kind of get a quick review about how 2021 kind of looked like. First of all, there's a lot of things going on, and a lot of things that people are concerned about. For example, we had a pandemic, and even until today, we're actually still in a pandemic. Now, obviously, we have inflation worries, and we have a slowdown in China as well. And then, of course, now we have the Fed and their reaction, and the trajectory of rates over 2021, and how that will kind of affect us all the way here in our homeland Malaysia. So there's a lot of questions about many sort of factors going into 2022. And if I were to put it rightly, if I were to put it very simply, I think everyone is on some level dealing with uncharted territory today, which is why I'm very excited to have our guests for us in our panel forum today. In fact, the perfect guests for a macro conversation. So today we have Nishad from Moody's, who is going to take us through the regional and Malaysian economic outlook. And of course, followed by Ivy Ng, CFA from CGS-CIMB. So she is the head of research from CGS-CIMB, and she will be taking us through her outlook on equity markets for the coming year. And then we will wrap up the session with Fawwaz, who is the global head of fixed income, head of global fixed income in PNB. And with that, he will be taking us through the fixed income markets for 2022. So before we go into that, we just want to have a pulse check on all our participants for today. If we could launch the poll, if our dear CFA Society staff can launch the poll. What we're trying to do is really try and have a glimpse into what does the audience think in terms of what are the main markets to look out for in 2022, what are the main investment themes driving markets in 2022, and where do you think you should put your money in for this particular year. And so I'm going to give everyone just a few seconds to kind of select and answer the poll, kind of see what everyone is really thinking about. So what do we have? So in the meantime, I would also like to say that during our Q&A, during our panel discussion, please feel free to log into this Meet site. So it's a meet.ps site. So just take your QR code scanner and kind of scan this QR code, or you can also use the link on the screen and kind of keep those questions coming in, flowing in through, so that we can get this session as interactive as possible. So with that, maybe we can have a look at the poll answers, the results of the poll. Do we have that? All right. So what we can see is that before we start this session, we kind of see that most of the audience think that political developments will be the dominant theme, yeah, influencing the Malaysian market in 2022. So we then followed, I think, rather closely by Fed taper or rate hikes, and as well as a return in consumer confidence. So these are, I would say, the three major themes right now before we get into our panel discussion. Everyone seems to be quite positive and constructive on equities. Can Fawwaz kind of change your mind, or does he agree with you? Yeah, that's also something that would be nice to see after this. And finally, which sector do you kind of want to, which sector do you want to kind of put all your money on? Which kind of which horse do you think will win the race? It seems that about 60% of our audience thinks that banking is a place to be, followed by the technology and semiconductor sector. So let's have a listen to what Ivy has to kind of say about this later on. All right. So with that, come let us jump into our first speaker for today, Mr. Nishad. So Mr. Nishad is an AVP, an Assistant Vice President and Analyst at Moody's. He's currently based in Singapore. And he covers the sovereign credit portfolio across Asia-Pac and writes thematic research on the region's ESG issues. Previously, he was a risk officer in Wells Fargo, responsible for setting internal credit ratings for countries in Asia-Pac, as well as an economist for the US Treasury, wow, specializing in South Asian economies. So Nishad, all the way in Singapore, how's the time difference treating you there? Yeah, probably
not bad, not bad.
Not bad, huh? Not
yeah.
bad. Huh? Anyway, but thank you for coming all the way. And over to you to take us through our first presentation for today.
Okay, wonderful. Thank you, Farid. Great. And if we could pull up the slides, please.
So sorry, Nishad. Could we take a few seconds? A bit of issue with loading the slide.
Sure.
Maybe in the meantime, Nishad, I can kind of ask you, like, how things over there. Like, have you seen any major changes in Singapore regarding, say, COVID or COVID restrictions at this particular point in time?
Yeah, sure. I think things are pretty much unchanged despite Omicron. I mean, there are obviously vaccinated travel lanes, including with Malaysia, that were suspended for some time just to see how things develop. But I think the government is trying to treat this as trying to treat it as endemic. So I think the case counts and the hospitalization rates and all of those things, they're really tracking the most acute cases rather than before, where they were testing more frequently and reporting the cases, the larger number of cases. So I think things are moving in the right direction. Hopefully, still working from home for the time being, but hopefully we'll go back into the office in the next few weeks and rejoin my colleagues and so forth. But yeah, it's not so bad. Hopefully, I was excited to hear about the travel lane with Malaysia and the bridge with JB opening up, but that was closed for a while. But hopefully, can take advantage of that soon. So.
But I think that the traveling was kind of was halted, right? Right.
That's right.
It's still going on. It's still halted, right?
Yeah, it was halted, but I think they'll restart it soon. Resume soon. Yeah.
I see.
Yeah.
Hopefully, probably in time for the Chinese New Year holidays. That would be that'd be really nice.
Yeah.
All right.
Nishad, Caroline here. So sorry. We're trying to just project your slide, but if you have your original deck that you sent, do you think you could project that?
Sure. Why don't I do that?
Yep.
Just give me one moment.
Thank you.
Sure. Okay, hopefully you all can see that.
Yes, we can.
Okay, very good. Great. So thank you so much, Farid and CFA Society for having me. It's a pleasure to be here.
But
unfortunately,
just
not.
1 second.
Sure.
Nishad, I think right now you're sharing the presenter view. So do you, yeah. Let's go into the, yeah.
Apologies.
No worries. Yeah, it's still on the presenter view.
How is this?
It's still on the presenter view. All right, now it's great. Yeah. Okay.
Yeah, it's okay.
All right. Over to you. Thank you, Nishad.
Okay. Apologies, and thank you all for your patience. Yeah. So thank you to CFA Society for having me. It's a pleasure to update you. I thought I'd give kind of a quick 10-minute primer on our current sovereign and economic outlook for Malaysia, with some insights on perhaps the region and how Malaysia fits in our regional view as well. Some of the key messages that I hope to cover is firstly that we do see that the economic reopening and export diversification that Malaysia enjoys will support the growth recovery. So in the context of the region, where maybe some economies are more dependent on domestic consumption, domestic services, we do see Malaysia as one of the sovereigns that benefits, I think, from continued robust external conditions, and really the high vaccination rate that will support reopening of the economy that we've already seen. Secondly, I think really is the inflation picture. I know that's a hot topic right now globally. I think in our baseline assumption, we see that the inflation picture will remain relatively benign in Malaysia, and I'll discuss a bit more on those factors in a bit. But really, I think some of the key drivers are pointing to maybe modest policy normalization this year from Bank Negara, and therefore the monetary policy environment should remain relatively benign domestically. Thirdly, and I think this is really where the key risk lies from our point of view, is the fiscal risks. As we've seen with the budget, as well as the 12th Malaysia Plan, the government is really embarking on a decisively more expansionary fiscal policy. And I think that reflects both the government's desire to continue to support a cyclical recovery in the economy as it reopens, but also I think the 12th Malaysia Plan embeds a larger quantity of public investment, higher social spending that will drive larger deficits, wider deficits for longer. And so what does that mean for debt consolidation? We do see that there will be challenges for debt consolidation absent any sort of significant revenue reforms in the medium term. Fourthly, I think on the external side, we still see that this is a key strength for Malaysia. And really, we've seen during the pandemic that even with the services deficit growing, with the borders being closed and tourism having contracted, really the commodity sector and electronics, E&E sectors have driven exports significantly higher, especially in the last 6 months or so, 6 to 12 months. And so this is supporting the BOP dynamics, and I think that will be an important consideration as we just talk about the Fed tightening cycle that is likely to commence soon. And then really just briefly, some of the downside risks we see are obviously rising inflation, as that feeds into potentially interest rates and to consumer buying power, financial market volatility, and kind of short-term capital outflows under Fed tightening. And then, of course, I think clearly the poll showed this, that people are concerned about policy gridlock and some political uncertainties, given that the current government I think it's still an open question as to the current government's electoral status. So touching on growth first, as I mentioned, we do see the growth recovery hinging really on this benign, fairly strong external picture. Export growth will of course moderate globally, and in China as well. Export demand, I should say. But nevertheless, I think it's still a very robust picture. There's still a lot of economies recovering from the pandemic, and this approach to zero COVID, I think, is is dwindling in many countries, if not China, but certainly in other countries are eliminating their zero COVID mentality. So in terms of growth, we see Malaysia's economy recovering to around 6% growth this year and next. This is broadly in line with ASEAN, I would say. Of course, many high growth economies in the region, so that's not particularly surprising. And slightly above our median for the Asia Pacific region. Now, a lot of this growth recovery is driven by base effects, of course. So, we did see that because of the MCO in 2021, the various stages of the MCOs, the lockdowns, that the recovery that we saw in many economies last year has been pushed into this year. So in many respects, this is just a recovery that's been delayed. But nevertheless, I think private consumption and perhaps a new investment cycle commencing will support the recovery. And I think vaccination rates are a key ingredient to this, where we see that during the MCO period, the vaccination rates were low in Malaysia, but very quickly we saw that starting with Sarawak and then of course in the peninsular states, vaccination picked up very rapidly, and now Malaysia is the second most vaccinated country in the ASEAN region among the large economies in ASEAN, and second only to Singapore. And of course, the booster program has already commenced. So the government has made it clear that it intends to not take a zero COVID approach, that COVID will be endemic, and therefore we do bake this into our baseline that private consumption should recover, services consumption should recover over 2021 certainly. Turning to inflation, I think Bank Negara has typically stood pat on rates, and of course during the pandemic has reduced, eased its stance appropriately so. Of course we have seen that headline inflation has ticked up more recently. From our perspective, I think our baseline assumption, really looks at inflation around 2 to 3% this year, which I think is reflecting some base effect, and also I think there's still quite a lot of labor market slack. I think Bank Negara's reaction function will more focus on core inflation, which has actually remained quite low, even relative to pre-pandemic, even relative to pandemic levels, and certainly compared with pre-pandemic. And so I think Bank Negara will focus, we think Bank Negara will likely focus on not just core inflation, but also just the economic recovery. How is the trajectory in terms of the investment cycle, employment, unemployment rate, and all of those are still on a recovery path still. So I think, in terms of the monetary policy normalization, I think we could probably, we're expecting it sometime in the second half of this year, but certainly not at a pace that needs to be reactive to the Fed necessarily. Now, as I mentioned, the fiscal risks are a key credit consideration and key credit risk to look at, and this is where we might see the most downward pressure on our current A3 rating, stable outlook. As we see on the left, in the pre-pandemic years, Malaysia's fiscal deficit was, compared to peers, and here we have sovereigns that are in its rating peer group, so across the globe in all regions, so rated between A2 and Baa1. Malaysia's fiscal deficit typically has been wider than its peers in peer sovereigns, around 3% of GDP, but nothing too high. And Malaysia has adhered to its fiscal rules in the past. But what we see is that across the board, all sovereigns are maintaining higher fiscal deficits even after the pandemic. And I think this reflects some of the social pressures for higher spending, and of course the need to drive economic recovery. But nevertheless, in its peer group, Malaysia's post-pandemic average fiscal deficit will be around 6% of GDP, which is higher than most of its peers, and certainly will present challenges to the fiscal trajectory, assuming growth, if growth were to underperform, let's say. On the right-hand side, we see, I try to combine two metrics here that we look at, which is, the debt burden, but also the revenue base. And so what this is showing is the proportion of general government debt to revenue as a percent. And in Malaysia, it's almost triple the median of its peer group at, almost above 450% in the forecast years. And really what this is reflecting, of course, is that the debt burden has risen. It will stabilize, we think, this year and next. It's just around 65% of GDP, the debt ceiling. But nevertheless, the revenue base has narrowed over the past several years. And in our baseline, we don't assume any significant uplift to the revenue base, unless the government considers a GST reenactment perhaps in the future. And then finally, I'd just like to touch on the strength that we see, which is the BOP side. And here we have the key components of the current account balance. And we do see that, largely in the last few quarters, really since the pandemic, what's been interesting is that we've seen the goods surplus increase substantially, really reflecting the E&E sector, and then more recently oil and gas, of course. But concurrently, the services deficit has widened, and really reflecting the tourism, the border closures. And so going forward, I think we see this potential for kind of a virtuous circle where the goods balance should remain strong while the services deficit narrows, and that should support the current account balance. And in my view, this will provide some support to the currency, perhaps, or capital flows, given that commodity prices, oil prices remain strong and above our baseline assumption, and also the government's baseline assumption in the budget. And therefore, this should provide support to the BOP, regardless of, I think, some of the signals we've seen from the Fed. That's our baseline assumption around that. So I'll stop there and look forward to the discussion. So back to you, Faiz. Thank you.
Thank you very much, Nishad. That was very succinct. Very, I think we managed to get quite of the, a number of the key themes. So I already have some questions lined up for you. But before we go into that, let me introduce our next speaker. For today, we have our next speaker for today. I'd like to introduce Ivy. So Ivy is a legend in the industry, of course. Who doesn't know Ivy? So Ivy is the current head of Malaysia Research and regional head of Agribusiness at CGS-CIMB, and she has been in the industry since the mid-90s. Where she kind of looked at palm oil, and she is the #1 ranked Malaysian strategist from 2017 to 2020. So it's with much appreciation and much gratitude that Ivy can join us with us today. And now over to you, Ivy, for your outlook on the Malaysian equity markets. Thank you.
Yep. Thanks so much, Farid, for the kind introduction. And I'd just like to thank CFA Society of Malaysia for inviting me to this event. So should I share my screen? Yeah.
I think it's okay, right, Caroline?
Can everyone see the screen that I have been sharing?
Yep.
Okay, I've stopped sharing my screen.
Okay, everyone can see?
Yes.
Yes.
Move on to the next few slides for Ivy to start her presentation.
Yeah, okay. Yeah, I can see it. Okay, so as you can see from the title of my strategy note for 2022, we do see some dark clouds for the Malaysian equity market, but we are hoping that there'll be some silver lining as well. So can you move on to the next slide, please? And the next one, please. Yeah, okay. So I'll just start off by sharing some of the challenges that we see for the market. Then I'll talk about previous slide, please. The slide number 5, please. Yep, that's it. Thanks. So basically, I will start off with the challenges, then I'll talk about some of the positive points for Malaysia, and then I will share the strategy that we are advising clients for 2022, and also some of the key policy areas to watch out for the equity market, because some of these policy decisions by the government could potentially impact some of the major sectors in the equity market. And then I will talk a little bit about the trading themes that we are looking at for 2022. And I'll end with our top sector pick for Malaysia. Now, I'll start off with the challenges. So we see a couple of challenges. The first one being the new Omicron virus. But over here, I think the strong point for Malaysia is the fact that we have high vaccination rates. So currently, the new COVID cases are pretty manageable at 2,000 to 3,000 new cases, and the hospitalization rate are also, very manageable. But I guess the risk here that we are trying to look at is what if Omicron lead to high COVID cases and high hospitalization cases in Malaysia. If that happens, we could potentially see new measures to restrict movement and so forth. And if that happens, it's going to be negative for the equity market because it could pose corporate earnings risk. And this is the potential downside to the market because at this juncture, I think investors in the market are expecting Malaysia to recover smoothly, from the various lockdowns that we've witnessed throughout 2021. So this is one area of risk to watch out for. The second one is with regards to the Fed taper and the potential hike in rates in the US. Now, historically, during this period where you have Fed taper or US rate high, you could potentially see foreign funds flowing out of emerging market, and that would include Malaysia. But the good news, I guess, to some extent for Malaysia is that foreign funds have been flowing out of market. Today, the foreign shareholding for Malaysia is close to its all-time low since global financial crisis. So our view is that in terms of foreign fund outflows due to the Fed taper, for this year, we think that it's going to be less significant compared to previous year, simply because foreign shareholding in Malaysia for equity is pretty low at about 20.4% as at end of December 2021. Now, the other challenges would be, some of the fiscal stimulus measure that the government gave out during the COVID period. This fiscal stimulus measure is all going to end, by second half of this year. Some of the fiscal stimulus measures include giving cash handout, allowing withdrawal from EPF for EPF members, one-off withdrawal, and that has resulted in outflow of about 101 billion from the EPF. And then you have other measures like loan moratorium and so forth. So the impact of this reversal of some of the measures or the ending of some of these fiscal measures is potentially less liquidity in the market that could potentially compress the valuations that investors are likely to pay for Malaysia equity. And then the next one would be monetary policy tightening in Malaysia. Our economists are projecting 2 rate hikes for Malaysia. All of them are likely to happen in the second half of this year, and they're looking at 50 basis point hike. Now, if you have higher interest rate environment in Malaysia, some of the retail investors that have been investing in the stock market for higher return may revert to other form of investment, potentially savings and so forth, because they don't want to take as much risk. So there could be potential impact on the equity market as well. Now, in terms of impact on corporate Malaysia, we noticed that a lot of Malaysian corporates have seen some interest savings from the sharp drop in the interest rate over the COVID period. That one-off benefit is probably going to end as well with the rate hike that we are expecting in the second half of this year. Now, there are also a couple of regulatory risks that we have to watch out for Malaysia in 2022. One of which is the return of intraday short selling. Now, prior to the start of this year, the government has suspended the intraday short selling. So to some extent, we see a little bit less volatility in the market, but with the return of this intraday short selling, where your prop desk will be allowed to short sell during the day, we expect for 2022 potentially more volatility for some of the stocks in the stock market. for 2022. So that would be an event to watch out for as well. And then we also have the policy that was announced in budget 2022, where the government raised the stamp duty rate for the trading of shares by 50%. And we think that this measure is likely to affect some of the retail trade and potentially retail interest in the stock market. We are yet to see the impact, I think, but we are starting to see that trading volume in the market may have come off a little bit at the start of this year. But I think to get a better picture of the potential impact, if any, on the retail trade in Malaysia for 2022, we probably have to see retail share of participation in Malaysian market for the month of January. Now, the other risk that we are studying is the corporate earnings risk. Now, for 2022, we see three potential areas of earnings risk for corporate Malaysia. First is the higher taxes. This is the one-off prosperity tax that was announced in budget 2022. We have incorporated the additional tax to most of the corporates that are affected in Malaysia. So I think to some extent, market have incorporated some of this earnings risks in their earnings forecast. So we are not too concerned about the corporate earnings risks from prosperity tax, but we are more concerned about corporate earnings risks coming from potential margin compression for companies that are not able to pass on higher costs by raising their selling price. Now, this has been played out somewhat in the market. And we can see that recently the government have delayed the tariff hike for tenaga. The government have imposed ceiling price for poultries. And they have also asked some of the companies as to why they are raising prices of companies. So this is an area that we are more concerned because it's harder to forecast and predict, but an area that we are watching very closely for corporate earnings for 2022. The third potential earnings risk for corporate in 2022 would be the performance of the commodity price. Now, a lot of the Malaysian companies are exposed to commodity price. If you look at the top 30 stock in Malaysia, you have petrochemicals, palm oil, and aluminium producers. Now, all these commodities prices were at record high last year. They are still pretty firm going into this year, but the concern is that if the prices started to correct, and if it's correct more than expectation, then we could see potential earnings risk for some of these companies. So the performance of the commodity price would be something that will watch out against the expectation of the market. The next two risks is about retail interest in the market. Now, if you look back into history, if you look back at 2020, we saw a lot of retail participation in the market coinciding with the glove rally. And because of the interest from the retail investors, we saw that the market valuations were able to expand up to 3 standard deviations above the mean. Now, recently, we've noticed that retail interests have somewhat dissipated. And the concern here is that with less retail interest, we have seen some PE valuation compression for Malaysian market. So that is also an area to watch as to how much liquidity are there in the Malaysian equity market. Now, the last one is political risk. And I think this is a major concern for investors in 2022, and rightly so, because based on our recent conversation with political expert speakers, Ben Sufyan, he was telling us that his assessment for political risk in 2022 versus 2021 would be higher in terms of volatility, and this is because of 3 potential reasons. One is that currently the government has an MOU with the opposition parties, Pakatan Harapan, but that MOU is due to expire in July 2022, and following the expiry of the MOU, we could potentially see election being conducted from then on or up to mid of 2023. So with GE election, if they are being held earlier, we could see volatility. Number two is that we have this weekend, we will have about 5 to 6 million new voters coming in due to the automatic voters registration bill. And this will mean that you have more voters voting for G15, and this will make it harder for us to predict who are likely to be the winners. And you could see perhaps more fragmentation in terms of the votes for G15. So it's uncertain whether the political instability situation that people are worried about will be corrected in G15. And the last one to watch out for with regards to political risk would be to watch out for the election results for the political parties like UMNO, which are supposed to be held this year. So a lot of events to watch for politics in 2022, and that could mean some volatility in the market due to political risk. Now, I just want to share quickly some of the silver lining for the market. As I mentioned earlier, we have very high vaccination rate, so that should protect us from a lot of these variants from COVID-19 and so forth. And this is one of our strongest point for 2022. So market is today pricing in a smooth recovery, I would say, for the Malaysian market. Now, the second point with regards to silver lining is we do see additional liquidity available for domestic institutional funds like EPF and so forth, because a lot of the one-off withdrawal schemes that was introduced under the various stimulus packages that have ended. And with the additional liquidity, we expect local institutional investors to come back and invest in the Malaysian stock market. So that should be supportive for the stock market. Now, the third point is with regards to the valuation for the market. Today is trading at about 1 standard deviation below its 3-year mean. So I think to some extent, what I've talked about in terms of the challenges have been priced into the market. So our market is not expensive. So that is a positive because it would mean supportive in terms of valuation. Now, the next part I just want to share is that in terms of policy events that we should watch out for, I think the first one to watch out for is whether the government is going to continue with the single wholesale network model for 5G rollout, because the decision on this could potentially impact some of the telco companies in Malaysia. The other policy events to watch would be whether all the sectors like plantation, manufacturing will be able to get foreign workers in 2022, because there's been a ban on foreign workers intake since June 2020. And then we want to watch some of the ESG issues, whether Malaysia will be able to tackle these issues and change the perception of Malaysia's conduct on ESG, in particular with regards to forced labor issues that have affected the rubber glove companies, the palm oil companies, as well as the EMS companies over the last 1 to 2 years. A sector that a lot of investors are keeping a close eye on is the construction sector. They have seen not that many big projects being rolled out since GE14, and so the sector has been underperforming, but there are some expectations that the government may decide on MRT3 going into 2022. And if that happens, we could see potential interest returning to the construction sector. And the last one is with regards to the digital banking license. We are expecting, and Bank Negara has stated in their website that they are looking to announce the winner of the digital banking license sometime in February this year, if I'm not mistaken. And that will be probably an interesting development as well to see what kind of services these digital bankers are going to roll out for the country. Now, in terms of trading teams, we offer about 6 trading teams for investors to look at. One is looking at the beneficiary of the rate hike that we are expecting, the 2 rate hike in second half of this year. And the key beneficiary here will be the banks. So if you want to invest in companies or sectors that's going to benefit from the rate hike, I would advise investors to look into the banks. The other theme that investors are also looking at is the value and leg up plays, and typically sectors that fall into this bucket would be your property, your construction, and to some extent some of the gaming stocks, because they've been badly affected by the COVID-19. Now, recovery play are those that exhibit strong earnings growth, you know, in 2022 and 2023 versus 2019, and typically you find tech stocks in this category. Now, we also advise investors to look at companies which have exposure to electric vehicles, and you'll find there are a couple of names in Malaysia that have that kind of exposure. We also ask our analysts to rank the ESG conduct of companies within their sector, and that's how we arrive at our ESG pick. And the last one is on dividend yield stocks that we think will still be appealing for some group of investors in 2022. So with that, I think the top sector picks that we have for Malaysia, we have banks, tech, and you can see that a lot of the recovery sectors are some of our top sector picks for Malaysia for 2022. Can we move on to the next slide? Okay, I'll just go through some numbers. I think in terms of market performance, and if you are studying Malaysia equity market performance, previous slide, please. Yeah, against all the other key markets, you find that Malaysia have posted negative return in 6 out of the past 10 years. So I would say that the reason for the weak performance have to do with the exit of foreign funds and the fact that corporate earnings for Malaysia are not as strong as some of its peers. Can we move on to the next slide, please? Next slide, yeah. So just to touch on foreign funds position in the market, what you see in this slide is that the blue bar shows you the net selling by foreign funds on an annual basis. And what you can see here is that for the last 4 years, we have seen foreign funds selling in the Malaysia equity market. However, we do notice that the peak of the selling was in 2020 during the COVID period. And in 2021, we have seen selling subsiding. And can we move on to the next slide? And part of the reason for this could be because they have sold most of their holdings. Currently, if you look at foreign shareholding in Malaysia, it's close to its all-time low post GFC of 20.3%. The current foreign shareholding is roughly about 20.4%. Also, another trend to note about foreign interest in Malaysia is that it seems to have peaked sometime in March 2018. And that is just 1 or 2 months before GE14. So I would think that the political instability in Malaysia or volatility in Malaysia may have contributed to foreigners selling down their position in Malaysia. If you look at the timing of the previous peak of foreign shareholding to current. Next slide, please. Yeah, and this is just to touch on some of the figures for retail participation in the market. What this chart shows you is the share of the various investors group trade in the Malaysian equity market on a monthly basis. And what you can see is that the light blue bar is actually the retail share of the trade. Now, what we can see from this chart is at the peak of the glove rally, we saw retail share of trade going up to as high as 44%. And today is at 30%. So it would appear that retail share of trade have come off. But if you compare this number against pre-COVID period, which was probably around, say, January 2020 to March 2020 or February 2020, you will have noticed that it's still slightly above, say, the 28% prior to COVID, but it has come down a lot since the peak of 44%. And I would think that part of the reason for the lower interest by retail participants could be also due to the end of the glove rally. Next slide, please. And this chart basically shows you the net buy and net sell position of the investor group. And you can see that similar to what we saw earlier in terms of retail share of trade, it has come off about, the net buy position of retail investors has come off by half on a half basis to 4 billion in the second half of 2021. We also want to show that because of the one-off withdrawal scheme that the government announced during the various stimulus measures, we saw local institutional investor being net seller in Malaysian equity market for the most of 2021, and we do expect a reversal of this trend in 2022 for local institutional funds, and retail interest may have subsided a bit, so the net buy position may have fallen slightly. And as for the foreign investors, we think that they'll probably be trading in the market. Okay, I think, do I have any more slides after this? Okay, it looks like there's no more slides, so I'll probably end the presentation here and pass back to Farid.
Thank you, Avi. That was fantastic. It was really fantastic and really insightful. Thank you so much for that. And now over to our next presenter, Fawwaz. Do you mind if we? Yeah? Right. So Fawwaz is the head of global fixed income here in PNB, and he kind of looks at ex-Malaysian fixed income, and he's over 8 years working experience with us. So very glad to have you with here, Fawwaz. Right. So I'll pass the floor over to you. Thank you.
Thanks, Farid, for the kind words and for the invite. Assalamualaikum and good evening, everyone. So we are shifting away from equities to a less sexy or finance class in fixed income. So I'll try to keep this session as interesting as possible for you guys. Can we move on to the first slide? Okay, now if you take a step back and revisit the year 2020, right, where COVID outbreak really hit the market at the start of the year, we've seen how bond yield across region kept on tumbling to record lows to reflect the severe setback in economies and how the different parts of the world were facing a crisis like no other in recent years. China bond was probably one of the few exceptions that we saw year over year, yields trended higher as it was perceived to be ahead of recovery compared to other major economies back then. However, since then, we've been hearing this term, I'm sure everyone has been hearing this term of unprecedented, uncharted quite a bit, right? And truly enough, we saw how major central banks responded with aggressive easing policies, extending rollout of unconventional policy tools that include QE and yield curve control at some point, and even unified with the governments on the fiscal initiative to aid the economy. So building on this, we moved to 2021, where start of the year was fueled with much of optimism on the back of recovery and global growth, and this was further strengthened by the global vaccination program rollout, particularly in the DM region. So this backdrop then drove the sell-off in bond markets in Q1 last year as investor priced in reflation rout from the faster than expected economic recovery, together with the inflation overhead concerns. Now, probably an oversight from most of us is that we fail to realize that the extent of being in this period of unprecedented or uncharted times. So we tend to downplay the uncertainties and noises lingering around the road to recovery, where everybody thought it would be smooth sailing from the ultra loose policies and also on the vaccination success. Probably the first realization came in sometime May, April last year, where we first witnessed the first variant of concern, the Delta variant. And subsequently, we went on to having Lambda and latest being Omicron, and also on the COVID impact to the financial markets itself, like how we still witness until today the severe damage in the labor market, which is still struggling to lift off. Probably since then, investors have priced in more downside risks, and consequently, we have been seeing a lot of lockdowns in major economies, and that have anchored yields uptrend trajectory to a much more modest pace. Now, moving on to 2022 and the year ahead, we see the central banks unwinding the accommodative policy and work towards the policy normalization back to where it was pre-COVID. What is the main key driver to rates normalization? And as a result of these rising policy rates and bond yields, we will expect to diminish the return prospect for most bond investors. Moving on to the next slide. So in short, we can say that the near-term outlook in fixed income market is broadly remain bleak, and it doesn't make much value to have substantial exposures in these risk-free assets in the likes of government bonds or even the high-quality investment-grade credits. So to make our investment worthwhile in this space, we should take more risk within this asset class, and to do so is by going down the credit spectrum. And we should be shifting away from DM markets to build up our EM exposure, and concurrently moving from IG to high yielders to capture these pockets of superior yield pickup. However, investors have to still be mindful of the interest rate rising normalization. So hence, despite extending your risk, you might want to reduce your duration portfolio so that your price sensitivity would be mitigated. So for us, investors who are primarily based in Asia, it makes sense to diversify out to regional peers like in the likes of China and Indonesia to take that added risk. But at the same time, we are constantly in touch and somehow almost on the ground by having close proximity to this market. So by firstly investing in these high yields or in junk bonds or such, the immediate risk that come to the mind is that the probability of defaults. So I see this is somehow mitigated as we progress towards recovery, growth. We expect economy to be resilient and stronger, and to add on, we still have flush of liquidity in the system. Hence, we will be seeing this default rate probability to trend lower, which is already in a downward trend from the COVID-19 peak, and should remain stable at a low single digit in the foreseeable future. In terms of thematic place within the fixed income space, the top two things that bond investors are looking at this moment are ESG and also on the broad EM or China penetration. So we've all heard about this ESG, not just a phenomenon in the equity space, but also in the fixed income market. In fact, in the next slide, we will go through how the risk return profile for ESG bond had improved in recent years. Investors are looking at more is ESG integration in fixed income instruments, and in particular within the high yield and also in the investment credits. And this ESG appetite is shared across most investors, including players such as the global fund managers and institutions alike. And the other theme is on the risk-taking EM markets, and particularly in China. China could probably be one of the few exceptions that will remain on a loose monetary policy path in the near term, and its inclusion in the major bond indices is still appealing to investors. So on the balance, I would say this is one of the few markets that has the most upside relative to other regional bond markets. Next slide, please. Next slide, please. Okay, so if you look from a quant perspective, right? So if we do a back test and look at the historical performance of this different asset class, in essence, what we can find that the optimal allocation, which is closer to the efficient frontier, is skewed towards this dollar-based bond. And this includes the likes of both IG and high yield across the regions, namely the riskier ones in EM, Middle East, as well as the havens in the US. We can also see that while the US and European equities generally do offer a superior return relative to bonds, they do so at a consistently higher volatility. Malaysian equities, on the other hand, had offered a poor risk-adjusted return profile across this time period tested. Last point to note that is that I think more importantly that ESG bond have been gaining traction, especially towards the end of the last decade, and it continues to gain investors' favor over time. And we expect this risk-reward profile to improve accordingly. And this relates to both sides, where on demand side, we are seeing more long-term stable investors having more traction in this. And also on the supply side, we'll be seeing a lot of more investment-grade issuance in the ESG space. Moving on to the right panel, if you look at the 5-year correlation study, we see that the China bond exhibits actually a low correlation with other fixed income markets. And from here, it acts as a good diversifier if you have a bucket of a mixed portfolio. And looking at the US high yield bonds, it somehow have the potential to lower your overall beta risk due to the low correlation to other asset classes. Again, another point to note is that on ESG, while it doesn't offer good diversification, as you can see, it has a high correlation to the investment grade, it could potentially serve as a substitute to the traditional IG penetration moving forward, as you can expect this correlation to stay positive and strong in the coming months or years. So in a nutshell, these findings back or further give support to the troubled themes of looking at ESG, allocation to EM, and broadly to the need to take more risk, as the limited pocket of space to capitalize within these income markets. Next slide, please. So for Malaysia, we will expect the same story as other EM peers, as we expect inflows into the region on the back of risk on sentiment. Yield is expected to trend higher given the broad policy normalization path. However, pace is expected to be modest given the support from real money investors. Key risks unique to the domestic bond would include the political uncertainty as well as the potential downgrade, sovereign downgrade. But so far, both risks have been subdued, with few global rating agencies reaffirming the Malaysia sovereign rating sometime mid last year. I think I will probably just stop here. I'm just being mindful of time. I'll probably proceed later on during Q&A session. Thank you.
Yeah, sure, Fawwaz. No worries about that at all. Thank you very much for that. And for whatever it's worth, I thought you made it very sexy indeed. So let's go on to our last section for today, which is the Q&A session. We've already had quite a few questions come in here from our guests. From our audience members. However, if you would still like to submit your questions, please do put them. Just go to the link that I've put on the chat and just go and submit your questions at our meet.ps platform. Right. So with that, let's kick off with the first question. Yeah. Maybe I can direct this to Nishad. So, Nishad, I mean, we talk about inflation, right? And then, if you were to look at any, I would say, financial newspaper, it's almost every day, where we're hearing inflation. But I was quite surprised to also see that, in your outlook, you kind of thought that Malaysian inflation is going to be a little bit more benign. So my question will kind of go along these lines, which is, what is really driving this difference in the inflation outlook here in Malaysia with, say, more advanced economies like the US and Europe?
Sure. Thank you, Farid. It's a good question. I think there's a few factors I would point to. I mean, first, I think in some of the advanced economies, the recovery in demand has already been in train for some time. So I think you've had a demand side surge, so to speak, a very strong recovery in the labor markets in some of these countries, coupled with the supply chain, the supply side issues that we've seen really emanating from APAC and other regions, that are selling goods to the US and Europe, for example. So I think some of the inflation dynamics that we see in the advanced economies are perhaps more idiosyncratic to their macro developments. Whereas I think in Malaysia, there's a few factors where I think, first of all, the labor market has not reached full recovery at this stage, although it is recovering quickly. So perhaps it's really just, I think, maybe the sequence or the stage that Malaysia's economy is in vis-a-vis the advanced economies in terms of the labor market recovery. So that's one. Second, I think is there is a degree of administered prices in Malaysia. So the government is able to ease prices or ease some of the burden of inflation through various subsidies. That does also support, that does kind of smooth out the inflation trajectory. And then finally, I think really it's, there's still very weak, investment in the economy. There's still weak consumption. So in terms of those core inflation pressures, I think it's still quite a ways away before some of those pressures return to a point where the, Bank Negara might have to act. So, so it is interesting. I think also maybe some of the supply chain issues that we've seen, affecting the advanced economies are less relevant to APAC in the sense that some of the, a lot of those supply chain issues are related to downstream, economies that are the downstream consumers of what's being produced in the region. Whereas I think domestically, things like food and fuel and those sorts of things, the supply chain constraints have been less acute within countries like Malaysia, I think. So I think all of those factors is sort of what's informing our view on that.
All right, thanks a lot, Nishad. Maybe you can switch, to hear what is Ivy's thought. So Nishad mentioned about supply chain, supply chain constraints and how that's kind of affecting the normal business of things. So if you were to look at Malaysian companies, the listed companies and such, do you see from, have you heard anything from management about supply chain constraints maybe easing or Is it still an issue at this particular point in time?
Yeah, I think if you look at some of the port operators in Malaysia, I think our sense from them is that, if you look at the congestion at the port, it seems to be easing. There was a little bit of disruption during the flooding incident towards the end of last year, but that seems to be easing a bit. But I guess the big cost increases for a lot of the corporates that we speak to has to do with higher logistic costs, of bringing imported food into the country, commodity price being at record high and having to eventually pass this on to consumer. So those cost increases are still coming in this year because towards the end of last year, a lot of the corporates decided not to raise prices to some extent because they were concerned of demand being still weak because we are locked down. But now with the recovery happening and people are going out perhaps more confidently, they cannot bear the cost increases anymore. They are starting to raise prices. The other aspect of cost increases that we notice in the market has to do with the lack of foreign workers because we have banned the intake of foreign workers, and they're bidding up the salary of the foreign workers that remains in the country. And that also is a form of cost inflation for some of the companies. And they are starting to raise salary even before the government decides on the minimum wage decision that is likely to happen perhaps mid this year. So that's another area of cost increases for Malaysian corporates. And that's why you see them passing on the costs and price inflation in some parts of the economy this year.
All right, thanks, Ivy. Just now also you kind of mentioned a little bit about how the stimulus is kind of running out. I mean, here in Malaysia, the stimulus is kind of running out maybe in the second half of the year. So I kind of just want to maybe direct a question to Fawwaz. Yeah, I mean, with the stimulus kind of running out, do you see the risk of default for some of your bonds kind of creeping up?
I would say not really though. It really depends on the creditworthiness of the different corporates, right? So as I mentioned earlier, as we progress towards recovery and growth, we will have some strong in terms of capacity to pay out, right? So in that sense, we would be seeing a much more lower default rate. And it's been trending on a downtrend actually since the peak of COVID, right? And it's forecasted to be trailing further given the improve in economic backdrops.
Okay, thanks. Maybe we can cycle a little bit back to Nishad. So you touched a little bit on debt levels. Yeah, so my question is kind of related to, I would say, maybe Malaysian public debt levels. Globally, it's pretty high, but here in Malaysia, I mean, as you saw, it's also one of the highest in the regions, or at least amongst the ones that you compared. So, I mean, what do you think are some of the ways that the government will kind of, what are some of the methods or some of the ways that the government will sort of employ to deal with this?
Sure. So I think certainly the rise in the debt level, I think is, the government's been quite transparent and clear about its intent to maintain this wider fiscal deficits and expansionary policy to support the recovery. So I think they've been quite open about their intent there. In terms of their strategy to manage that, I think there's a few things. First of all, I think a strong growth recovery will obviously be very supportive to that. And so I think, in 2021, there was, revenue was trending quite positively until the MCOs came into play and the National Recovery Plan. And then, of course, with the lockdowns, revenue suffered quite a bit. But I think over the medium term, the recovery of the economy, I think, should provide at least some buoyancy to the revenue that we haven't seen in the last couple of quarters. Another thing I think to look to is if you look at the budget for 2022, there's I think quite a bit of conservatism baked into it, in the sense that you look at the oil price assumption, you look at some of the revenue growth assumptions. And also it excludes some of the extra measures that Ivy had mentioned, like the prosperity tax in their baseline. So I think there's potential for some revenue upside that may also narrow the deficit, maybe reduce their financing requirements, and therefore ease the debt burden. A final point maybe I'd make is that our debt burden, our calculations for debt include some of the contingent liabilities that we deem as explicit liabilities. So namely 1MDB and the subsidiaries of 1MDB. So our debt burden is somewhat higher than the statutory level that the government indicates. So in that regard, there are some maturities coming up this year for 1MDB and next year as well. And the government, has the liquidity to service those maturities. So I think that should also help stabilize the debt burden. But really, I think for us, it's really a growth story. I think it's growth that will have to that will really drive the debt dynamics here in terms of stabilizing the debt burden, and then in future years starting to consolidate that burden.
Understood. Ivy, I mean, you mentioned political developments as something that will be a major I would say a major theme driving Malaysian market for the next I would say the next 4 quarters. So in your opinion, with this high debt levels, do you think the government still has, I would say, a little bit more room for their typical strategy of giving out some handouts and some goodies to the electorate?
Yeah, I think they will probably continue with some of these policies in their budget, but maybe may not be as high as during the COVID years, because the growth, the projection of higher growth should be supportive of employment numbers and so forth. So people should be being able to get jobs and so forth. So I think they will be focusing on getting jobs for the unemployed this year, and in terms of handouts, at best probably stay the same. They will want to grow the economy and so forth. I think that is the focus. I think the other focus, other areas perhaps the government is quite concerned of heading into election is the cost of living. I think if prices of essential goods go up too much, it could affect the government standing to some extent. So I think that is an area that the government will really look into and tackle. So I think, that's why we are quite concerned, because if the government were to put in price control and so forth on some of those items that affect our corporates, then we could potentially see margin compression for some of them if they're not able to pass on those costs. So I think in terms of advice for investors who are looking into the market, I think we want to look into companies with strong pricing power. So that is an area to look into for companies that you want to invest in 2022.
Thank you very much for that, Ivy. On that note, Fawwaz, do you mind giving us some color? Like, what's the supply-demand situation like for government bonds at this time? But before we go into that, before Fawwaz your answer, I would like to remind our audience, keep your questions coming in. We'll be asking those questions just very soon. And so over to you, Fawwaz.
In terms of supply, if looking at specific Malaysia bond market, right, the MGS and GIS supply, we expect it to increase given the level of debt that the government has to finance. But however, I think with this increase, we still have a modest support coming from our real money investors in light of EPF, to name a few. And also we still have these foreign inflows to come in and take up. So I think how we can see it, right? So being an investor in the DM markets and the other low yield country, right? If you want to take risks, you want to go to EM, right? So if one of the EM markets that's going to be profited from this would be Malaysia, given the relatively higher yield pickup compared to other regional peers and on a good sovereign rating outlook. So in that sense, yes, supply will be more, but definitely there will be demand for take-ups.
Right, thanks a lot, Fawwaz. Let's take a question out of the hat, so to speak. And I would say that the most upvoted question is on ESG. Yeah, so maybe I think we can maybe hear from Ivy on this. I think this one is, but everyone is of course free to answer. Ivy, the number one question from our audience members today is, how ready are Malaysian companies to be qualified as an ESG pick?
Okay, so I think it's all relative for in terms of how we pick ESG companies. So we look at how transparent are the company in terms of how they are planning and how they are adopting the ESG in their business practices. That is one area we also want to hear from the management in terms of their commitment. And we also want to track not just what they put out in their annual report, but whether they actually achieve some of these targets. So I think going through all this, we get a sense of which companies are ahead of their peers in terms of adopting ESG and which one are behind in terms of ESG adoption. I would say that relative to some of the regional peers, I would say that some of the Singapore companies appear to be ahead of Malaysian. If I look at the names in the agribusiness sectors, so the names in Singapore seems to have better transparency. They even got their ESG data audited, whereas for Malaysia, we are still trying to raise the game on this ESG. So I expect more from the Malaysian companies. We have improved a lot in the past few years, but there's still lots of room for improvement.
Thanks, Ivy. Nishad, do you have any views on the ESG readiness of Malaysian companies here in Malaysia?
Maybe not on the corporate side, not my area of analysis, but I mean, I think maybe just one point on Malaysia for ESG. We did see the government issue a sustainability sukuk earlier this year or last year. Which was, kind of a maiden issuance. I mean, very, very kind of market groundbreaking, I should say, in terms of US dollar sukuk and the ESG space, which I think was interesting, just given that the sukuk market obviously is very well developed, a big source of finance, and could be a model for other sovereigns to follow in terms of financing some of their sustainability goals.
All right.
For to add on.
Yeah,
to add on Nishad's comment. So I think, so the Malaysian government issued the first green sukuk, right, in the dollar space last year, and since then also they've announced they're going to be one ringgit sustainable bond this year as well. So I would see that's a push factor for most of the other corporates in domestic market to really go ahead with this ESG initiative. And in other markets, we've been seeing a lot of bond market issuance being in the green space. So I'm just trying to market fixed income space for you, not just on equity, you're looking at ESG, but also on the fixed income side.
Noted, duly noted on that. Maybe I can sort of direct the next question to, I would say, maybe Nishad. Nishad first, and then maybe you can hear a little bit from Ivy. So China, so we know there's a lot of things that's coming out of China at this particular point in time, right? There's the regulatory overhaul. There is also, some conflicts with the US, especially, some tensions coming over Taiwan and so on and so forth. So on that note, do you see any spillover effects from that here in Malaysia?
Sure. I think, so maybe one of the key channels would be, if we look at the property sector in China and also the Common Prosperity Plan, I think both of those we see as in the next, say, 1 to 2 years affecting growth in China. I mean, I think by design, in the sense that they do want to focus on high quality growth to address some of the lingering financial stability concerns in say the property sector, for example. So we do see it affecting the macro picture, the growth picture in China, and therefore, I think will affect export, demand for Malaysian exports, let's say energy and other goods. I think on the Common Prosperity side, I think what's interesting is the regulatory crackdown is, in sort of the Moody's view is that we think it's, in the short term, it will create regulatory uncertainty. There is an antitrust component to it. But over time, we think if we want to talk about ESG, it is sort of trying to address some of the social inequalities in the country, some of the social pressures that may be emerging from the development of some of these tech companies, or sort of companies that have escaped regulatory scrutiny over time. So that may benefit Malaysia in a sense if we see that perhaps tech companies in Malaysia, the tech ecosystem can develop because of some of that regulatory uncertainty. It could also potentially, in our view, maybe harm Malaysia if it affects the Chinese growth outlook, growth trajectory, and therefore demand from its trading partners.
Yep. Okay. I will probably add a bit more in terms of how we see some of the industry potentially benefit from this US-China trade war. So recently we had some conversation with some of the tech experts in Malaysia, and they are saying that the US-China tension is benefiting Malaysia somewhat, because we see opportunities of some of these companies setting up plants in Malaysia. And recently, I think we've seen the announcement of Intel investing, I think, 6 or 7 billion in Malaysia and so forth. So the semiconductor players are very excited about this potential, but they say that the concern that they have is that their lack of skilled workers in Malaysia to be employed in this industry. So they are talking about the shortages of engineers in the industry and so forth. And this is an area that they would like the government to address in order for us to capitalize on these potential opportunities.
All right, thank you so much, Ivy. All right, so another one out from the audience hat, the question hat, to Fawwaz. I think this particular audience member wants a kind of a recap for 2020 to 2021 to kind of understand why bonds in Malaysia didn't quite perform. So do you mind explaining a little bit some of the I would say the negative drivers of bonds in the last 2 years?
Sure. I think when you invest in bond, it's like you're buying an insurance, right? So basically you buy bond when you see negative outlook in the market. And what we've seen in 2021 is on a risk-on driver going up from devastation from a COVID crisis. So in that sense, it's not the most looked at asset class at this point of time. So the only drivers for you to be staying invested in bond in the coming years is more of some sort of risk diversifier, also or probably a risk insurance buffer, those kind of perceivedness. Definitely is not the most appealing fixed income instrument. It's a boring asset class, and it's not the appealing one at this point of time, given the market outlook. So in short, when times are bad, bond is good. When times are good, bond is bad.
So there's an inverse relationship between them. Another question from our audience member. I think this was it's quite it touches a little bit on one of your top picks, Ivy. So it says from a retail investor's point of view, is it too early to invest in 5G related funds?
5G related companies?
Yes.
Yeah, okay. I don't think so. Depends on which part of the supply chain of the 5G are the company's exposure is. I would say that for some of those that are already having quite a bit of exposure to 5G, I think they're going to ride the 5G trend, which will be happening over the next few years. So I don't think it's too early to invest, but I think what is more important perhaps is to look at the levels of the company's share price and the valuation levels before investing. So I think on this point, you have seen that recently some of the tech plays in Malaysia have been sold down in line with the Nasdaq because people feel that some of these stocks have very high valuations because of the liquidity that we see in the market, and there's some profit taking there. So I think if there's a profit taking in some of these good, well-managed tech names with exposure to 5G, a growth area, then there's an opportunity for investors to pick up some of these tech names. So perhaps not to chase it, but to look at opportunity to buy it at good levels.
Understood. On that note, I mean, just to touch a little bit more on stocks and some sectors, let's talk a little bit about plantations and how it kind of did. Yeah, I mean, we saw CPO, kind of really rally throughout the year, in 2021, but we didn't see plantation companies do well, especially in the first half. Yeah, it kind of only moved, I would say, more in the third or fourth quarter. So how much of that performance can be explained by company specific drivers, and how much of that poor performance can be explained by, say, maybe ESG concerns by foreign funds and those kind of types of investors?
Yeah, okay. So I think for the plantation stocks, if you look at the valuation of the plantation sector in Malaysia, you would notice that even when CPO price were very low in, let's say, 2020, you don't see the share price of plantation companies actually coming off. So when we head into, say, 2021 or late 2020, when we started having ESG issues, and the price are going up, you have a combination of higher commodity price, but you have also the ESG issues. We saw that investors are actually net seller of the sector because they are concerned that this ESG issues is going to affect perception for palm oil, and then in the future we may see demand for palm oil being affected because of perception of how this palm oil are being produced, and because people are taking ESG concern, applying ESG concern into valuations in starting, I would say, more aggressively in, say, 2021. At the same time, you have all these forced labor issues, and you have US CBP, issuing, WRO banning or limiting supply of palm coming from Malaysia. It gives the perception, the palm oil sector in Malaysia turning even more negative than before. Before that, we already got some issues with perception on palm oil. So I think because of that, we saw foreign investors actually exiting the sectors. And although the local investors may not have exited the sector that much, but the fact that you have foreign outflows, that means less liquidity going into the sector, you find that there was a bit of valuation compression facing the sector. But this is partly offset by the higher CPO price. But then at the same time, if you look at government policy in Malaysia, the plantation companies are not able to capitalize fully from this higher CPO price because they cannot get workers. So even though the price are good, they cannot maximize their production because they don't have enough workers. So that's somewhat dampened the potential upside in terms of earnings for planters, and you combine that with the ESG concern, foreign outflow, and so forth. I think we saw a little bit of a correction on the plantation company's share price. And I think going into 2022, we expect the share price to be in a kind of trading range for plantation names.
All right, thank you, Ivy. All right, so we have about 3 more minutes left. Yeah? So I'm gonna ask the final question to the panel. Yeah? Anyone wants to have a comment on where they think the ringgit will go for the rest of this year? We will have to try.
I'll take the hit first then.
Okay.
So I think the overall narrative is still on risk on, right? So this will be bearish on dollar. So in terms of that, we are looking at a broad EM upside in terms of the local currencies. So I would say ringgit will be profiting from this, and where we will see ringgit is definitely at the close lower 4 anchor. That's how I see it. To break the 4 anchor, I think it's gonna be pretty hard. Yep.
All right. Thank you so much, Fawwaz. Now, can we get the last poll out? Yeah, can we get the poll to be asked again? Can we launch the poll again, so that we can see whether there has been a change in expectations for post this particular session? While waiting for the answers, does anyone want to have any last words for our investors in the room today? Maybe we can start off with Nishad. Any last words?
No, I would just say, I think in our sovereign view, I mean, we are trying to balance we do have a constructive view on the growth outlook. Certainly, I think within the ASEAN region, it's, Malaysia stands out, I think, in terms of its growth potential for this year. But again, it's the fiscal trajectory that we'll be looking to keying in on closely in terms of how revenue shapes up this year and also any reforms that are on the table. Thank you.
Ivy?
Yeah, so my advice is for investors to be nimble in the market for 2022 because we do expect volatility, but we do see potential opportunities to pick up good names in the market. So, keep a close eye on the market. I think there'll be opportunity as well as, although there's risk as well.
Thanks. Fawwaz?
Yeah, in terms of allocation, definitely I will overweight my equities exposure over fixed income. But then again, you might want to have this exposure still as your risk buffer, as how we see 2021 didn't really lift off. And if your concern on where this fixed income asset class will be value is more on the going back to the fundamentals, as this asset class provide you that stability in terms of constant income and so diversify to your overall equity portfolio diversification. Thank you.
All right. Thank you so much, Fawwaz. Okay, can we see the results of the poll to see whether there has been any major change post? All right, so we still see political developments as the #1 driver, followed by Fed taper and rate hike. So there's no change there. In fact, on the second one, which asset class, we actually saw an increase in increase in equities. A lot of people choosing equities, and finally, we see no major changes in the sectors which people think will be best performing in dealt with banking as well as tech. So, all right, with that, thank you very much to all our panelists for today. And also all the audience members. Thank you very much for your questions. Thank you to all the panelists members for your very insightful, insightful presentations and for answering the questions. And with that, I would like to wish everyone a good evening and good night.